Banking, Housing, and Urban Affairs will come to order. Today's hearing, as others have been is a hybrid format, or witnesses are in person. Members have the option to appear in person or virtually. My colleagues and I often say that the U.S. markets are the envy of the world. Our strong and diverse economy and the rule of law benefit families and workers saving for the future. The breadth of our markets allows many workers to plan for the long term and to take advantage of low-cost, diversified investment funds. Whether investing for retirement or for college tuition, low-fee, broad-based index funds have been an essential resource for millions of families. That's become more important over the last few decades as corporations have cut or eliminated pension plans, and fewer workers have a union to fight for their retirement security. For all the benefits index funds provide, they draw criticism for everything from being Marxist to promoting anti-competitive business behavior, to being too active in the affairs of the companies they own, or too passive in the affairs of the company they own. Many academics, including our witnesses today, have considered aspects of these questions. We'll hear from our colleague, Senator Sullivan, who recently introduced legislation that addresses his concerns. To be sure, there are important questions to consider given how important index funds are for retirement accounts and pensions. Today's hearing considers how index funds vote on company shares, whether fund investors should be able to vote on the shares held and managed by the fund advisor. In some way, this issue boils down to one question: who should exercise the market share that index funds have gained? The law professors testifying today can tell us how corporate and securities law grants power to the fund directors and fund managers. Critics say that puts too much power in the hands of too few people at the largest fund companies. Some skeptics say that fund companies have too much influence over corporate America to pursue activist social policies. Other critics say fund companies should be doing more to hold public companies accountable. We know index funds are long-term investors that think about long-term results. This debate, to me, is about how we hold corporate executives accountable and make sure they're thinking about the long-term value of their companies. It means putting at the center the workers and the communities that make these companies work, not just the next quarter's profits. It's just common sense. Sometimes the long-term success of a company means voting in favor of policies that consider climate risk or workplace diversity or human capital management. And now, all of a sudden, there are people who don't want index fund managers to vote. I'm afraid that's what would happen under Senator Sullivan's bill. As we'll hear, the Index Act strives to achieve democracy for fund investors. It starts by singling out index funds, taking aim at the biggest firms, but potentially capturing even smaller fund companies. The bill says fund managers can't vote company shares unless they get direction from the fund investors. It's an idea that sounds democratic, but doesn't consider the cost or complexity or the sheer number of votes involved. For popular, widely held funds, index funds, that could mean reaching out to hundreds of thousands of clients, about tens of thousands of corporate votes each year. Industry data tells us that savers who own stock on their own, not through any kind of fund, vote only about 30% of the time. It's hard to imagine that someone who specifically picked a professional to invest their money for them would want to become an expert in corporate proxy voting and be forced to keep track of hundreds of corporate meetings. It's an obvious problem, so the Index Act solves for it by telling fund managers they don't have to vote even though current law requires them to. The act would then leave Americans whose money invested in these funds with two bad outcomes: either to have no voice because the bill protects fund managers when they don't want to ask for directions on voting, or to be inundated with votes on thousands of corporate issues. To complicate things further, the Index Act could give more power to short-term investors or large foreign investors. Smaller companies could be worse off because the bill would make it more expensive and time-consuming, a federal mandate of sorts, to reach out to stockholders. Index funds are targeted in part because of their success, but if we're really trying to improve transparency and accountability for fund managers and for public company management, it's important to consider potential areas in reforms in this area without undermining the clear benefits that index funds provide, that is low-cost access to diversified savings and investments. The SEC is working to improve the process of corporate voting and increase transparency, and market participants are developing technology solutions to improve the voting process. The current system, of course, is far from perfect, but moving to a system that would suppress voting or potentially give more influence to short-term interests is not the answer either. I look forward to hearing the testimony Today, from the two professors and from our colleague, Senator Sullivan, we'll hear some criticism, but also some solutions. I think it's important to start this conversation. Ranking Member Toomey.
Thank you, Mr. Chairman, for holding this important hearing. You know, over the last several decades, there's been an amazing democratization of the American capital markets. Today, retail investors have access to investment products more easily and at lower cost than ever before. They have zero commission trading, narrower bid-offer spreads, all kinds of convenient and user-friendly interfaces. Retail investors have access to countless low-cost or even zero-expense passive index funds and ETFs. And it turns out investors particularly like low-cost diversified funds that track an index like, say, the S&P 500. At the end of 2021, index funds had held $12.5 trillion in assets. Index funds have been a tremendous boon for retirement savings. However, the tremendous growth presents a problem. A retail investor who buys an index fund technically doesn't own the stocks in the fund. The fund owns the stocks, and the fund's manager can decide to vote them. That gives the managers enormous influence over companies, even though they're voting shares purchased with other people's money. Now, this would be a problem even if the voting power were dispersed, but it's not dispersed. The stocks held by index funds are heavily concentrated, with very few large asset managers making these entities disproportionately influential with every large public company in America. Collectively, BlackRock, State Street, and Vanguard are the largest voting blocs in nearly 90% of S&P 500 companies. They derive much of their voting power from ordinary Americans who buy index funds. Even though this isn't the manager's money, and they're supposed to be investing this money passively, they're nonetheless voting these shares. I'd like to highlight two problems that arise from this consolidation of corporate voting power. First, some asset managers are using their voting power to advance their own political agendas. They're voting on shareholder proposals and board nominees, and by virtue of this power, they can apply pressure over companies even outside of the formal votes. An example, last year, BlackRock, Vanguard, and State Street all backed the efforts of Engine Number One, a small hedge fund owning just 0.02% of Exxon's voting shares, to install on the board of Exxon, America's largest energy company, directors who are sympathetic to the fund's global warming activism. Engine Number One's effort to install board members who want to fundamentally remake a giant oil company succeeded only because the Big Three agreed. Now, does anyone seriously believe that all of the Big Three's investor clients actually want Exxon to transition away from the very business that has made it a remarkable success? Now, there are plenty of actively managed funds that investors can choose that'll pursue the reforms if those are the things that investors see fit. But passively managed funds aren't supposed to impose a strategic vision or agenda on firms. They're supposed to neutrally follow the market. Second, as I've noted, these asset managers are voting shares purchased with other people's money, not their own. Asset managers should not be using their clients' voting power to pursue political agenda of their CEOs or exercise control over corporations. Investors select index funds to track the market, not to have the big asset managers change the market based on their political views. Congress needs to address the problems of the largest asset managers voting other people's shares and their consolidation of corporate voting power. In my view, the solution is to return voting power to the true investors in a company, the people who put their own money at risk. Senator Dan Sullivan has introduced legislation, the Index Act, to do just that. I'm proud to co-sponsor it and delighted he's here today to discuss it. The Index Act requires any asset manager of a passive index fund with more than 1% of a company's voting shares to vote those shares in accordance with the instructions of the fund's investors, not at the discretion of the asset manager. Or they could choose to not vote at all. This means such asset managers, including for index funds offered under 401k plans, ERISA plans, and the thrift savings plans for federal workers and retirees, could no longer use and abuse the voting power of their index fund investors to advance their own agenda. Importantly, the Index Act recognizes the reality that index fund investors may want some guidance in deciding how to vote their shares, since there could be a large number of votes to cast. Researching and deciding on each of these votes individually is not realistic for most average investors, and that's why the Index Act requires asset managers to permit third-party vote recommendations on their platforms so that investors can consult these recommendations. And asset managers that provide third-party recommendations must do so on a non-discriminatory basis that allows investors to consult a broad range of views. To make the voting process simpler and more efficient for index investors, the Index Act would allow recommendations to take the form of general voting instructions given in advance. In other words, an investor could vote according to those general instructions and not on a case-by-case basis. I look forward to hearing from today's witnesses. In my view, further democratizing investing and diminishing the consolidation of corporate voting power are objectives that members of both parties can and should get behind. I hope that today's discussion will help us build bipartisan support for legislation that will achieve these important objectives. Thank you, Mr. Chairman.
Thank you, Senator Toomey. My pleasure to introduce my colleague from Cleveland. Senator Dan Sullivan is in second term in the Senate representing faraway Alaska. He will discuss his bill, the Investor Democracy is Expected Act. The Index Act addresses how index fund managers conduct proxy voting. Senator Sullivan, you're recognized. Thanks for joining us.
Thank you, Mr. Chairman, and I sincerely appreciate the opportunity to testify here. And thank you for holding this important hearing on this important issue. I want to thank Ranking Member Toomey in particular for his leadership and work with my team on the bill that's already been described, Investor Democracy is Expected Act, or the Index Act. And I want to thank other members of the committee. There's several here who are also co-sponsors of this bill. Mr. Chairman, I'll be frank with you. You and I have talked about it. The impetus for this legislation was due to my ongoing frustrations with many of America's largest banks and insurance companies that undertook policies to start blackballing oil and gas investment development in Alaska, and in my view, blackballing the proud American workers who do this very necessary work for our country. We need energy. While at the same time, these financial institutions, banks and insurance companies were eagerly and continue to eagerly do business with communist China. Blackballing American energy workers, no problem with investing in Chinese communist activities. Why are they doing this? Why were they doing this? Well, I found out these financial institutions do this in part because of pressure from their largest shareholders, the big three investment advisors and their index funds. In time, my Alaska-centric frustration uncovered a much larger concern that many of you have already described today about the sheer power that is consolidated among the three firms that were already mentioned and the massive distortion in our public markets that it creates. Here again are the astonishing numbers that were already mentioned by Senator Toomey with regard to BlackRock, Vanguard, and State Street. They manage around $20 trillion in combined assets, are the largest owner, shareholder in around 90% of the S&P 500, and cast nearly 1/4 of all votes at annual meetings for public companies in America. These numbers were even larger before the recent market correction. In many ways, as you mentioned, Mr. Chairman, this is a success story. Investors are benefiting from greater diversification and lower fees. However, there have been unintended consequences, especially the unprecedented consolidation of ownership and voting power of these three firms. These companies wield this market dominance through behind-the-scenes engagement with company management, and they can steer our public markets towards policies that they or others prefer, bypassing political accountability of our legislative process. This should concern all of us, regardless of political party. Some may like or even applaud the positions these entities currently advocate for, but as we have all seen, leadership at these kind of firms can change. Just look at the ongoing Twitter saga right now. At its core, the Index Act is politically and policy neutral, focused instead on the very real and unprecedented power amassed by the big three investment advisors that should be a concern of us all. And I know this is becoming a concern on both sides of the aisle. I've had discussions with many of my Democrat and Republican colleagues. In fact, just a few months ago, Senator Bernie Sanders held a budget committee hearing on these same issues. The bill simply requires that investment advisors of passively managed funds vote proxies in accordance with the instruction of fund investors, the American people, and not at the discretion of the advisor. It would return voting power back to the beneficial owners of the shares, not the index fund managers. In many ways, it's a logical next step that was undertaken in Dodd-Frank, when broker-dealers used to be allowed to vote shares they held in street name, although the beneficial owner was not allowed to vote those shares. That was changed by Dodd-Frank. Mr. Chairman, you mentioned already some of the complexities, but Senator Toomey has also mentioned some of the ways in which these complexities of implementation could be addressed. The Index Act would accomplish important goals. It would neutralize the massive power that the largest investment advisors have amassed, and it would empower the real beneficial owner of these shares. It would foster a healthier and more competitive and democratic corporate governance system, which is what we should want and certainly what the American people expect. I will close with a quote from Jack Bogle, the founder of Vanguard and the father of the index fund, who voiced a warning before his passing in 2019. He said, quote, "If historical trends continue, a handful of giant institutional investors will one day hold voting control of virtually every large U.S. corporation. Public policy cannot ignore this growing dominance," unquote. Mr. Chairman, this day is upon us. This prophetic warning has proven itself out, and we need to act in a bipartisan manner on this important issue. I look forward to the rest of the hearing today and working with all of you on this issue, and I would encourage all of my colleagues to consider the Index Act as a bipartisan solution. Thank you again, Mr. Chairman, Ranking Member Toomey, for the opportunity to testify today.
Thank you, Senator Sullivan. Thank you very much for joining us. The chair calls up the two witnesses today. Professor John Coates IV is the John F. Cogan Jr. Professor of Law and Economics at Harvard Law School. In 2021, Professor Coates served as acting director for the Division of Corporate Finance and as general counsel for the SEC. He previously served as chair of the Investor as Owner Subcommittee of the Investor Advisory Committee of the SEC. Professor Caleb Griffin is assistant of law at the University of Arkansas Law School. His research focuses on corporate law and corporate governance, with a particular focus on the role large asset managers play in the governance ecosystem. He served as a board member at Citizen Shareholder International as chair of the Stakeholder Engagement Subcommittee at the American Bar Association. Thank you for joining us. Professor Griffin is a remote witness. Professor Coates, if you would begin your testimony. Thank you for joining us.
Thank you, Chair Brown, Ranking Member Toomey, members for the invitation. The topic today, index fund voting, is quite an important challenge. Index fund success on behalf of Wall Street and Main Street has been so dramatic that they have, in fact, created legitimacy and accountability gaps. As I've thought about this set of issues for many years now, and I've written about it, however, I've come increasingly to the view that you should not really think of there being a problem to be solved, but rather a set of trade-offs, a dilemma that has to be managed as best we can. And what I mean by that is, as already been said, index funds have provided and continue to provide enormous benefits to American investors. They do it through low fees, low fee diversification, competitive pressure on other funds who have had to lower their fees in response to the success of index funds. And something that I think is directly connected here, and an additional benefit of index funds, is that they require almost no monitoring by the people who put their money in them. They know what they're getting because there's an index. They don't have to pay attention and use their time, which is, for most Americans, better spent in their day jobs and managing their children and doing other things, in tracking what their managers are doing. And that's different between index funds and other ways to invest. Even an active fund with a lot of professionals in it, they tend to turn over. And so you kind of have to keep track of an active fund to see whether they're continuing to do well for you as they might have in the past. So index funds provide all these benefits, and therefore, for my sake, even though I agree the challenges are real, the most important principle to bring to bear as you think about legislative interventions is let's first do no harm. Let's make sure that we're not going to dramatically impede the ability of index funds to do what they've been doing. Unfortunately, I believe the bill, while well-intentioned and an intuitive response to the challenges of governance, will in fact do harm and achieve relatively little benefit to offset that, even if your goal is for individuals to have more influence over how their shares are voted. The cost of a pass-through will be large, as has been adequately, and more than adequate, better than I can, stated by Chair Brown. Thousands of companies, thousands of votes, hundreds of thousands of investors. Data on existing individual participation suggests not likely to be used by many, and yet the costs will be imposed on everyone. Mutual funds, these are mutual funds, which means costs are mutual. So you might have some investors who would use these rights. My prediction is most would not, and the ones who don't would still have to bear the cost of the system put into place. That would make index funds less attractive and overall impede the ability of them to keep doing what they've been doing well. There's a fallback, as mentioned, mirror voting or not voting built into the bill, and I think actually this would be even worse for almost everyone, including people represented by the Business Roundtable or management generally. It would increase unpredictability in outcomes because it would effectively shift voting power from the index fund to other institutions, such as proxy advisors or activist hedge funds or management, depending on relative voting power leading up to a proxy fight that could change on a daily basis. It would make it, and I've talked to proxy solicitors about this who do this for a living, they think it would dramatically increase the unpredictability of voting precisely when it's at the most likely to be contested. Bottom line is, I think the goals here are good, but the remedy needs to be more cautious, more conservative, if I can use that word in a non-political way, more moderate and more experimental. So better transparency, I'm all in favor of that. Funds could do more to tell their shareholders about what they're doing. Better conflict management. Currently, conflict rules are in place at the fund level. They could be put in at the complex level. And I do agree they should be encouraged and given authority to take instruction from their investors. That, however, I think that's going to take pilots and experimentation to make sure it's done in a cost-effective way. And so with that, I will stop. I have other comments, but I'll stop there for now.
Thank you, Professor Coates. Professor Griffin, you were recognized, I assume, from Arkansas.
Yes. Thank you, Chairman Brown, Ranking Member Toomey, and members of the committee. I'm privileged to testify. I wanted to make 4 key points in my testimony today. First, we have a corporate governance system that is based in large part on empty voting, which distorts incentives. Second, the best interest standard, which currently governs index fund voting, is insufficient. Third, pass-through voting solves the empty voting problem and restores agency to investors. And fourth, pass-through voting is the lowest cost approach that will meaningfully address this problem. As has been discussed, index funds have assumed a new and unprecedented role as the most influential players in corporate governance. Particularly Vanguard, BlackRock, and State Street, known as the Big Three, play a pivotal role. And we mentioned that they cast about a quarter of the votes at S&P 500 companies. That's expected to grow to roughly 34% by 2028 and to over 40% in the following decade. So this rise shows no signs of slowing down. One of the great ironies of index funds is that while these fund managers have become the most powerful governance actors in the world, their investors are essentially powerless. It's the fund managers rather than their investors who wield the power to cast these votes. And I view the present situation as an accident. If given the opportunity, no one would have designed a governance system controlled by empty voting, where a party has control rights but lacks economic ownership. We explicitly recognize the costs of empty voting when we eliminated empty voting by brokers more than a decade ago. And empty owners have interests that are often poorly aligned with those of true owners, and they're much more vulnerable to conflicts of interest. And yet today, we find ourselves facing a situation where virtually all public companies will be controlled by empty voting. There's essentially only one substantive legal constraint that governs index fund voting, and that is index fund managers are required to vote in the best interests of their investors. And this constraint is surprisingly weak. To my knowledge, out of the millions of votes cast by all index funds, not a single vote has been held to violate this standard. As a result, I believe that index funds vote in a way that may be totally untethered from their investors' interests. I say maybe because we simply don't know. Index funds are not currently required to solicit any form of proxy voting input from their investors, and for the most part, they don't make a meaningful effort to do so voluntarily. They may be guessing in good faith about their investors' interests, or they may be voting in their own self-interest. But I view either option as much less desirable than simply getting input from investors. So what should we do? I believe that the best solution to the current problem, where we have virtually powerless index investors and then enormous concentrated power in the hands of index fund management, is to transfer some of that power to individual investors. I believe that there are two primary ways that we could do so. The first is to allow individual investors to set their own voting instructions. In order to streamline this process, I favor what I call categorical pass-through voting, where investors are able to give semi-specific instructions on common categories of topics. For example, investors would be able to instruct management to vote yes or vote no on all lobbying disclosures every time that type of proposal came up at a portfolio company. So it's sort of one decision that is applied many times. The second approach I call vote outsourcing or indirect democracy, and it's where investors could instruct management to vote their shares in alignment with a third-party representative. These may be institutional players, such as management or even the index fund managers themselves, or they may be third parties, such as nonprofit organizations. So that would be only a single decision made on the part of the investor, say, who do I want to vote on my behalf, as opposed to being forced into saying only my given index fund will have my vote. I believe that pass-through voting is the lowest cost approach that actually solves the problem. I think some evidence of this fact is the fact that a number of parties, including BlackRock, are already developing the technology to institute pass-through voting preemptively. And I think that this speaks to the affordability and the relative desirability of this approach, even from the perspective of the fund managers. I believe that other solutions, including antitrust remedies like breaking up the big three or capping fund complexes at a certain size, would be far more costly. I think pass-through voting preserves the economies of scale at the big three while addressing the root of the problem, that is concentrated voting power in the hands of a small, unaccountable group. Same amount of time. Thank you.
Thank you, Professor Griffin. I'll start with you, Professor Coates. The idea of passing through voting rights to fund investors sounds appealing, as you pointed out, but it's more complicated than it seems. You talked about a process to be managed. Describe, if you would, the logistical and practical concerns with trying to manage that kind of process.
Sure, I'll do my best to sketch a few of the challenges. It's actually going to be far more complicated than I can capture. But first thing to note is the scale of investment at the fund level. We're talking hundreds of thousands of investors who would have to be asked for instructions. Second, many of those investors are funds. They're other institutions. So if you really wanted to achieve, as the bill tries to push it all the way out to individuals, we're not talking about one pass-through. We're talking about 2, 3, 4 layers of funds. This is, you might think a little counterintuitive, but the way our market works, there's layers upon layers of institutions at work. Employee benefit plans sit on top of funds, which in turn invest in index funds. So that's a second kind of challenge. A third kind of challenge is, put aside funds, a lot of the individual investment in funds is through what are called omnibus accounts, brokerage accounts that aggregate individuals and purposefully shield from the fund the identity of the actual individuals for competitive reasons. So in order for those individuals to get to instruct, they would have to the fund would have to provide information to the brokerage firm, and they then would have to pass it through, re-aggregate, pass it back down. Now, there's a lot more that could be said to unpack the complexity here. The reason I'm fairly confident this would be costly, time-consuming, and error-prone is because our current system of voting at the corporate level, the basic voting that this is all going to be a part of, is still a work in progress. This year alone, as I have extended more notes in my written testimony, is the first time that the major players in the basic voting system are trying to provide confirmations back to investors about whether their voting instructions have been followed. This is for people who've chosen to directly invest. This is the first time in history they're going to be able possibly to confirm their instructions have been carried out. And the reason is the system is very complicated even at that level. We're adding 1 or 2 orders of magnitude of complexity on top of that with the way the bill approaches this. So I think it's just not workable, even if you imagine some large number of the fund investors wanted to take on the challenge of providing instructions.
Thank you, Professor Coates. Professor Griffin, your testimony suggests the Index Act could allow for a variety of options to get input from fund investors. Some fund managers, you had suggested, are working towards this. Do these solutions have potential in your mind?
Thank you, Chairman. I think they do have potential. I think that passing through several thousand votes for an individual would be, in many cases, unmanageable. But I think outsourcing the voting process, sort of decoupling that and saying, I could use third-party expertise of my chosen third party, as opposed to sort of being locked in to a single, whoever you happen to invest with. I think that actually sort of reduces the separation of ownership and control from a corporate law perspective, and I think reduces the harm from empty voting. And I think that there are certainly some costs here. It's not free, but I think it's important to view these costs in context. I think we need to think about not just the costs of facilitating pass-through voting, which I think are very manageable, and I think that they're expenses that funds have begun to undertake voluntarily. BlackRock currently offers it to about 40% of its index clients, primarily institutions. But to say that scaling that up is in no way possible, I think is a little bit unrealistic, given that they're building it out, have built it out for institutions, and are, in my discussions with them, currently in the process of building it out for retail clients. I also think that the cost of having empty voting dominate corporate governance for the economy at large could be very serious. Misaligned incentives can lead to very significant costs. Some academics fear monopoly effects. The common ownership literature is still pretty nascent, and I'm not an antitrust scholar, but essentially they say it can lead to price increases for consumers. One academic, Zohar Goshen at Columbia, even says essentially it is the type of governance philosophy espoused by the Big Three is responsible for decades of wage stagnation for employees. And so I think when you're comparing the cost of a survey and voting like investors say, I think it's clear that pass-through voting is a feasible option.
Thank you. I've run out of time, but Professor Coates, I'd like you to respond in writing to this. Your testimony suggests some potential improvements to the current process. As the former head of the former chief counsel at SEC, you have great insight to this. If you would outline some steps that SEC and fund companies could take to make sure public companies and fund managers are more accountable and more transparent, if you would put that in writing to us. Thank you.
I'll do that.
Senator Toomey.
Thank you, Mr. Chairman. Professor Griffin, let me just start with you here. You know, it's easy to see the enormous influence that the Big Three have when it comes to casting a proxy vote when they control a plurality of the votes. But in fact, that dynamic alone is only the beginning of the kind of influence they wield. If you, as one of 3 individuals, can effectively determine who sits on the board of directors of a company, doesn't that give you enormous influence over pretty much anything you choose to exercise influence over, because there's this implicit backing of your request in the form of changing the composition of the board? Could you comment on that, Professor Griffin?
Thank you, Senator. Absolutely. I think that the ultimate source of their power is the voting right, as you mentioned, but it is only the beginning. So one way they exercise their power is through, as you mentioned, being able to elect directors, but also through sort of a standard setting process. And this makes them almost a regulatory body in a sense, but without sort of that accountability that we expect. So when they announce their governance positions, or when Larry Fink writes his annual shareholder letter, there's academic studies that demonstrate these positions are very quickly and effectively adopted by a number of companies. They file 8Ks that have not just the same positions, but sometimes the exact same language as Larry Fink's letter. And so to Professor Coates' point earlier about predictability, I agree that there may be a reduction in predictability, but that predictability, the source of that current predictability is that companies are essentially doing what they're told by their largest shareholders. And I think that may be less beneficial than we might assume, because it creates a corporate governance monoculture, right? It's sort of a one-size-fits-all corporate governance. We say everybody should act in such and such way, and these asset managers have decided it and decreed it. And so it is predictable, but I think it's detrimental.
So now let's go to the heart of what I think is Mr. Coates' criticism, and I don't mean to speak for you, sir, but it's the way it sounded to me, and that is the challenge and complexity and cost of implementation. And we all realize that, of course, over the course of a broad-based index, you have many hundreds, maybe even in some cases thousands of companies, and the total number of votes is an enormous number. But as you know, Senator Sullivan and I and others worked on a variety of ways to deal with that complexity. BlackRock seems to think that this is manageable. In fact, they've already initiated this process. Could you comment, Professor Griffin, on the mechanisms that we've talked about to try to address the inherent complexity and the sheer scale of this challenge?
Absolutely. So first, we have the 1% cap, which says, look, this is only going to apply to the very largest funds. I think that helps to balance this proposal specifically only on the funds that could bear the costs. And I think that with respect to whether it's feasible to vote this many questions on this many companies, I think the two methods that we outlined to provide these types of voting instructions, whether they are categorical of every time you see such and such issue, do this, vote this way, vote yes or vote no. Every time you see a lobbying disclosure, vote yes to disclose it or vote no to not disclose it, either way. And then the company would apply that sort of at a blanket level at all, maybe 500 firms, let's say, in the portfolio. The second one I think is even simpler and requires only one decision from an investor to say, I want my votes to be voted according to this person. And so they specify one third party. It could still be the fund. Maybe some people really like the way that BlackRock votes, and that's totally fine. Under this system, they would be able to designate them as the person to follow in the voting process, to instruct, say, vote according to their recommendations. But I think under the bill, it would provide a neutral platform for third-party recommendations. And so that's one of the requirements in this bill, is to say, if you do provide voting recommendations, you have to present them from third parties on a neutral basis. And so I think that could actually open up a lot of competition for differing perspectives to enter and a diversity of views in the proxy voting space. And that could be really beneficial.
Thanks very much. I'll yield. My time's about to run out, but I would just point out that for people who think that this system works reasonably well or well enough, why they could select to continue with the status quo by choosing to defer their votes to the asset managers. Thank you, Mr. Chairman.
Thanks, Senator Toomey. Senator Reed of Rhode Island is recognized.
Thank you very much, Mr. Chairman, and welcome, gentlemen, witnesses. Professor Coates, as you know, and as you also indicated in your testimony, many investment managers currently engage outside proxy advisory firms for guidance. So how would this bill affect investment managers' reliance on proxy advisory firms?
Well, the pilots that have been alluded to by Professor Griffin and Senator Toomey that BlackRock is undertaking are a good illustration of how to answer your question. They're focused on institutional clients. The institutional clients who don't invest through index funds often rely on firms like ISS and Glass Lewis for voting advice. BlackRock's experiment is essentially extending that into the index fund space for institutions. I want to emphasize both that that means they're going to be now not simply following the decisions of the index fund managers, but they're now relying on proxy advisor personnel for their voting. This is shifting from one institution to another. I'm not really sure that that's achieving the goal that is stated for the bill. I also would note that that's a vastly simpler pilot, which is why BlackRock is starting with it, than passing through to individuals the same kind of options, which is in fact why, if you talk to each of the big three, they will tell you in point blank, it is 10, 100, 1,000 times more complicated and expensive to think about doing it for individuals, even if it's just one time a year we want ISS or some other advisor. Last thing I'd say is it's not true that other investors could just preserve the status quo and ignore this, because the costs will be borne by them. Unless you do more than is in the bill, which would allow the index fund sponsors to charge a fee to those individuals who want to do something beyond what is currently done now on an individual account level basis. I don't believe that would currently be permitted under the 40 Act, and I don't think anything in this bill directly addresses that problem. So I don't think actually that could be accommodated under the current legislative language. So in the end, just to come back to your question, I think proxy advisors who have been the subject of prior hearings and conversations between Senator Toomey and me about this suggest that he's not entirely comfortable with the role that proxy advisors play. They will get more power as a result of this bill.
One of the concerns I have is, I think it goes to the assumption that we're operating on, is that transparency, public companies with a direct connection to their real shareholders is really the model. But what we're observing right now is public companies going dark. They want to get out from underneath scrutiny and transparency. As a result, we have a growing number of, usually significant in terms of financial power, companies that have left the public sector and now lacking all transparency. I don't think it helps the markets. So wouldn't it be an advantage to have these companies reporting some basic information, like their audited financials, or if they reach a certain financial level, if it's a, $2 billion private company, that has a lot of impact in our society. Any thoughts on that, Professor?
Yeah, one thing that index funds have done that has not been noted is that because they provide so much capital, but it's only one entity, one record holder who buys the shares through an index fund because it's a fund. The actual number of record holders of listed companies has fallen dramatically over the past 20 years. And in fact, most of the companies that went public in 2021 when I was at the SEC did not go above the threshold requiring them to register with the SEC. As a result, we currently have a very different reality for counting what is a public company than we did when the securities laws were first written. And I do think there is much to be said for revisiting the thresholds that are built into the 34 Act, thinking about them in a different way, not simply counting numbers, because index funds make it possible for most listed companies to have fewer than 300 shareholders and still amass enormous amounts of capital.
Thank you very much. Thank you, Mr. Chairman.
Senator Kramer of North Dakota is recognized.
Thank you, Mr. Chairman, for calling this meeting, and Ranking Member Toomey and witnesses. Thank you. I am a co-sponsor of the Index Act, also a sponsor of another similar relating to traditional lending, the Fair Access to Banking Act. And I'm grateful to Senator Sullivan for focusing so much on index. This is just really, really important. I wanted to ask you, Professor Griffin, about no action requests. So, we see the SEC, we see the granting or the denying of no action requests. And first of all, is there a risk of less than even handling of no action with regard to the indexes?
I think speaking broadly, there has been some academic research that suggests it does matter somewhat which SEC staff member receives that no action request. And so there's been some academic research into that issue. And I think that is maybe evidence of what you're speaking about, that there's sort of personal variability within the SEC, maybe diversity of views on what is appropriate and isn't. I would also note that there's been some recent changes as to what can and can't be excluded, and so that someone might be asking to exclude a shareholder proposal from an upcoming meeting and requesting a no action letter on that basis. And I think that we've changed some of the policy there and potentially disturbed what some longstanding positions, but I think. With respect to index funds, I think it's not. I wouldn't say it's particularly a major issue with respect to proxy voting.
Sure. Let me ask you about the role of states, because we're seeing red state pushback, as they call it. Some states are, obviously not all states are created equal, but every state, particularly their state funds, provide a lot. I mean, there's a lot. And I think of a state like Texas, for example, West Virginia, another one that recently passed state laws similar to the Index Act. In some cases, they might even be more aggressive in terms of their own pushback guidance. How do you see any concerns about the federal government doing one thing or states doing their own thing? Or what if we don't do anything? What could be the outcome or the consequence of states taking this on their own and having if you will, a maze?
Thank you, Senator. I think that it will potentially become further politicized at the state level and then have sort of a difficult to navigate situation for these asset managers. And I think that can increase costs as well. And so certainly it's maybe the best course of action for those states if their citizens desire it. But I do think that there are risks to that approach as well. And the fragmentation that you mentioned, I think could be detrimental. And so I think that there's a desirability of a unified standard and federal action on this issue.
I almost never say that, but there are situations, there are a couple of places in the Constitution where they give the federal government some say, and I would think this might fit into interstate commerce a little bit. The one thing I just want to sort of wrap up with, Mr. Chairman, and you can certainly comment, Professor Griffin, if you'd like. Has anybody come up with an index like reliable electricity index or reliable low-cost energy index? We pick these very political sort of criteria in the energy sector with very little regard for. We talk about long term. We have to think the long term. Well, 2050 is a long ways off. 2030 is closer, but 2022 is on us. It's here right now, and inflation is not a fantasy. It wasn't created by Vladimir Putin, although he certainly has enhanced it with his behavior, but we were heading this way already. It just seems to me that if we're going to have indexes based on political criteria, they ought to be grounded in some science, not just somebody's perceived or even real crisis that's years off. And anyway, no need necessarily to comment. It's just my comment as we wrap up that let's be a little more realistic about governance. Thank you.
Thank you. Senator Menendez from New Jersey is recognized.
Thank you, Mr. Chairman. Under current rules, public companies are not required to disclose political spending to shareholders, and as a result, corporate executives can spend investor money on political causes without any consideration of shareholder views or the company's public commitments. Dr. Coates, should shareholders of companies that make public pledges expect their company to act in a manner consistent with the stated company policy?
Yes.
And we saw in the wake of January 6th insurrection, many public companies pledged to suspend or reevaluate political donations to members of Congress that sought to stop the certification of President Biden's victory, proving that these donations are a business decision that affects the company's reputation and therefore their bottom line. However, since then, many of these companies resumed their political donations in direct contradiction to their public pledges. So, Dr. Koch, do you believe that corporate political spending is material information that should be disclosed to investors?
On average, yes. I'm a supporter of the Disclose Act and have been since it was first introduced a long time ago. And I'm also a fan of getting rid of the micromanagement of the SEC with the budget writer that has forbidden the SEC from taking up this topic for the past 10 years. It's clearly, for some companies, their political involvement is first order to their strategy. And for them to not even be possibly asked by the SEC to make some disclosures related to that political strategy, to me just seems like an obvious mistake from an investor perspective. It has nothing to do with politics per se. It has to do with corporate strategy connected to political involvement.
Well, I appreciate that, and I fully agree. That's why I've been pushing for years to strengthen the SEC's political spending disclosure rule. We've also introduced the Shareholder Protection Act to allow investors to more directly influence the political spending of publicly traded companies. But enhanced disclosure of relevant information like this, in my mind, is another way to empower investors. The key to empowering investors, in my mind, is a strong disclosure regimen that includes and informs, I should say, consumers and allows them to vote with their wallets. When it comes to voting, many investment fund managers voluntarily issue proxy voting guidelines that outline for investors how the fund tends to vote proxies, as well as general principles that are considered. So, Dr. Koch, do you think this type of disclosure is useful to investors?
I do, and I think if you think about the premises of this bill, as backed by the various co-sponsors, it's that individual investors will lean into their rights as economic capital providers and use them, presumably on an informed basis, to make governance choices. The only way they can do that, the only way this bill could possibly work, even putting aside my worries about cost, would be if they actually had full information about what they were voting on. And if they can't get information about what companies are doing with their money, because remember, this capital flows down to the index funds, which is the focus of this bill, but then it flows down to corporations. So it's their money all the way down. If you want them to have the ability to reasonably exercise governance rights over their capital, then you need disclosure about how that money is being used, and that includes political activity.
Well, thank you. To me, this type of disclosure is exactly what investors need to make informed decisions while still maintaining the accessibility and cost effectiveness of index funds. However, it's also important for investors to be able to verify that the funds are actually voting in line with these principles. How can we make disclosures regarding votes that have been taken more informative and digestible for investors?
Well, the SEC currently has a rule pending that, if adopted, will help. It will improve the detail with which funds have to disclose their votes. I'm also in favor for the big index funds, the ones that are the focus of this bill, to report more frequently than they're currently required. Annually is all that's required now. They actually do it quarterly on a self-enforced basis. They choose to do that. I think they could do it even more frequently because the proxy season lasts for many months. And I think having more real-time disclosure and better disclosure would be the first place to start. That is how we have markets work rather than having law direct operations of companies.
Thank you very much.
Thanks a minute. Senator Van Hollen's recognized from Maryland.
Thank you, Mr. Chairman, and I want to associate myself with the remarks Senator Menendez made regarding the importance of disclosure by the companies for shareholder purposes. You know, I find the description or title of this bill, Investor Democracy Act, to be a little bit upside down, and here's why. I have some shares in Vanguard Mutual Fund, And I choose to make that investment. But Professor Coates, I could, if I wanted, choose to directly invest in the underlying stocks of the underlying companies, right?
Yes, you could.
And at least in return, Vanguard has a duty to look out for my, quote, best interests. Is that right?
That's right.
All right. Now, as I read this bill, because of the costs that this bill may impose on a money manager, Vanguard, they can opt out entirely. Is that right?
Yes, they would be permitted to simply not vote at all.
Right. And so I don't know how that advances the cause of democracy. If now Vanguard, because of additional costs, says, well, I'm going to opt out, then nobody is looking out for my, quote, best interest. Isn't that correct?
That's correct. It would effectively, I think, lead to less voting by the longest term investment funds that there are.
Right. And that means more relative voting by hedge funds and other short-term investors, right?
Yes, this bill would boost the power of Carl Icahn or Bill Ackman or pick your other favorite hedge fund activists to come in and vote.
I think that's exactly what it will do. And, you know, in my experience, I don't have any separate stock holdings right now, but I had some small holdings. I get these statements in the mail. I never have time to fill them out and vote my few shares that I had. And that's what would result in my view from this, as I think has already been discussed, some of the bigger, I think BlackRock has now made provisions for some of the larger institutional investors. I think that's important. But for retail investors, in my view, this is going to have exactly the result that you're predicting, which is to essentially, you know, have us not exercising our votes even through, you know, a proxy like Vanguard. And that just empowers the others in the system. Can you talk a little bit more about the costs that are imposed? Because one of the reasons people invest in these index funds is because they're low cost. And so if they're going to have to increase their costs, I'm not going to want to put any of my investments there. And so that will be an incentive for them to exercise the safe harbor rule. So can you talk a little bit more about the cost that this would impose?
Sure. One of the things that I've done in the past 20 years is first for the SEC and then for the Department of Justice, I've played a role in looking at how the back office functions of different investment managers function. And at the SEC, a long time ago, 2002, I helped distribute money under a fair fund back to the investors of mutual funds, large ones. It's an incredibly complex process simply to even identify who the investors in a mutual fund are. Many of them do not know. And the reason they don't know is because brokers bring them clients and the brokers don't want the funds to know who their clients are. So one of the major costs here would be simply for the funds to trace out through brokers and other kinds of intermediaries who are your investors to get instructions from. The bill doesn't allow them to do it in a differential way. It's all or nothing. And so I really believe, actually, when you total up the costs, the fund advisors will say, better we don't do this at all for retail. I encourage, let me just go back to the beginning. I think actually there is something here, but it's going to take experimentation and pilots. It's going to take SEC oversight. It's going to take leaning into figuring out what could be cost effective. The kinds of things that Professor Griffin sketches, I think, are nice ideas, but to make them really work, you're going to need some experimentation.
So under your reading of the bill, would it allow an investor in Vanguard to simply check a box and say, I want to opt out of this, Vanguard, you've got my proxy?
So the bill has some ambiguities to it, which is itself a separate issue that, of course, could be cleaned up. I don't think, as it's currently written, Vanguard could just provide an opt-in or out option. It asks for pass-through of voting instructions for every fund investor, or none at all.
So in your reading as written, it would require Vanguard to essentially send me my voting material for each of the constituent companies that underlie the index fund.
It specifically talks about each proxy statement for each company that has in the index. Yep.
So not giving me an option to opt out seems to me to be very anti-democratic. Thank you, Mr. Chairman.
Thank you, Senator Van Hollen. Senator Tillis is online from his office. Senator Tillis from North Carolina.
Thank you, Mr. Chair, and thanks to the witnesses for being here today. Index funds provide significant economic benefit to retail investors. I think we all agree on that. It allows them access to low-cost, diversified portfolios that do not require active management. However, since their creation, the concentration of these funds has grown significantly. The share of assets managed by the 5 largest firms rose from 35% in 2005 to a majority, 54% in 2021, while the share managed by the 10 largest firms increased from 46 to 66%. So, Mr. Coates and Mr. Griffin, is it fair to say that the concentration of assets under management by a handful of institutions is an unintended development that the creators of index funds and ETFs did not foresee?
Yes.
I'm sorry.
Professor Griffin, your answer?
Yes, yes, it is.
Now, the big three, BlackRock, Vanguard, and State Street, currently collectively cast an average of 25% of the shareholder votes for the S&P 500 companies. This is a significant block. However, I've looked at some research, and I'd like to get your feedback on it, that indicates if the current trends remain, the big three could control as much as 40% of the voting power of the S&P 500 companies within 2 decades. Do you agree or disagree with those trend lines, and why, Mr. Coates and Mr. Griffin?
Yes, I believe that the likely share of index funds in 10 years will be greater than now, in part because we're talking principally about investment decisions by retail, ordinary individuals, and they follow guidance and advice that's hard to change. So even if we got to a point where index funds were no longer the best thing, there'd probably be some inertia well past that point. So I think actually index funds are likely to continue to grow, and I think that's why the goal of the bill is a good one, to look into how most cost effectively to address the accountability problems that their growth has created.
Thank you. Mr. Coates?
Thank you, Senator. I absolutely agree. I think that we're looking at about 34% by 2028, which is not too far off. And in the next decade after that, about 2038, the predictions by Lucian Bebchuk at Harvard are that they'll have approximately 40% ownership. And so there's a range of values there. Obviously, we can't predict the future, but the trend of indexation shows no signs of slowing down.
Thank you. Mr. Griffin, in the time that we have left, the select few institutional investors control an outsized portion of voting rights. More and more, I hear from companies that these institutions utilize their voting block to force business decisions onto companies or otherwise coerce them. Should institutional investors, Mr. Griffin, should institutional investors be subjected to due diligence requirements when backing shareholder proposals?
I think that could be beneficial, and it sort of speaks to what their duty of care may be in this context. And I think that could certainly benefit from being fleshed out to an additional degree and having more due diligence.
Similarly, should institutional investors be required to disclose their analysis, proving their votes were in the best economic interest of their shareholders?
I think seeing their analysis could be beneficial. I think more disclosure is usually beneficial.
Well, thank you. Mr. Chair, I'm proud to be a co-sponsor of the Index Act. I think it would begin to address the distortion of power in our capital markets. This bill would return voting power back to the individual investors and foster a competitive marketplace instead of promoting a system where individual investors can crowd out everyday investors. Mr. Griffin, could you speak a little bit more on the merits or any concerns you have with the Index Act?
Certainly. I think that pass-through voting is probably the best and lowest cost option that we're going to find here. I think it addresses the root of the problem, which is this concentration of voting power in very few hands. I think that the fact that these many of these funds are developing the exact technology that we're looking at in-house. I do agree with Professor Coates that pilot programs are beneficial. I think BlackRock is effectively doing one right now. And so, perhaps there's a concern there's sort of a 2-year window in the bill. Perhaps, it may need to be extended to 3 years. I think I'd be open to something like that. So I think we should be sensitive to those concerns, but I think ultimately the pass-through voting is an exceptional idea.
Okay, thank you. My time has expired. Something Mr. Griffin and Mr. Coates may submit a question for the record. I'm specifically interested in the duopoly of the proxy advisor firms ISS and Glass Lewis, but out of respect for the chairman, I won't ask for an answer now, but would like to get your opinions on that. Thank you, Mr. Chair.
Thank you, Senator Till. Senator Daines from Montana is recognized.
Chairman Brown, thank you. I'm very pleased to hold this hearing today on, I think, a very important topic. I'm very proud to join Senator Sullivan in introducing the Investor Democracy as Expected, or the Index Act, which, as we discussed, would shift voting power away from investment advisors to individual investors who already have skin in the game and own the companies that are held in the exchange-traded funds that they also own. Passive investing through index funds has provided tremendous benefits to investors. But woke investment managers have created a downside of this style of investing. These asset managers, namely BlackRock, State Capital, and Vanguard, are using their clients' capital to advocate for viewpoints in the boardrooms of corporate America that their own clients largely disagree with. This should not be a political issue. This level of concentration of power should be concerning to Democrats who often talk about the problems with consolidation of power in a few hands, and this is exactly what we have in this situation. Here's an example that's been discussed previously, but it's worth repeating, is the woke, hostile election of directors on Exxon's board in 2021. Engine number one. This is an activist, environment, climate investment firm, successfully leveraged a 0.02% investment to oust 3 Exxon board members in favor of climate activist board nominees. This happened with the support of BlackRock and Vanguard, Exxon's 2 largest shareholders. Following its victory in this proxy battle, Engine 1 pressured Exxon to reduce its oil production. In October of 21, they put out a statement celebrating the fact that Exxon had reduced its oil and gas production as a result of their takeover of 3 members of the board. Fast forward to today. President Biden's begging oil companies, including those in Venezuela and the Middle East, to drill more to alleviate the energy crisis we're seeing both here and in Europe. This politicalization of our financial system is part of the reason I'm planning to introduce a bill to codify a 2020 Department of Labor rule, which would require plan fiduciaries in retirement plans to put financial factors above all their considerations when making investment decisions. This bill will simply clarify what nearly all investors believe is already happening, and that is that financial decisions on their behalf are being made to make them money, not to further a particular policy or political agenda. Turning to my questions. Professor Griffin, I've heard some argue that it would be too difficult to allow individual investors to vote their own shares held through an index fund. Would you agree with that assessment?
No, I would not. I think there's a number of tools to effectively involve individual investors.
Do you think perhaps the issue might be that allowing shareholders to participate in the proxy process might wrest away control of the outcomes from woke asset managers and corporations?
I think, it's not clear. I wish I knew exactly what sort of was in the mind of BlackRock with respect to why it exercised voting power the way it does. Some people view it as a pure compliance cost that they would sort of readily hand off if they could. Some people view it as a way to market what are essentially undifferentiated, commoditized products. One index fund has very little difference from another. And so with that regard, that may be what you're speaking to.
So what are your thoughts when you saw what happened with Exxon at 0.02% investment ousted 3 Exxon board members? I think if I'm investing in an energy company like Exxon, I'm assuming they're trying to find ways to increase oil and gas production, not decrease it. What do you think about what happened there, where you had some climate activist board members then suddenly take over part of Exxon?
Well, I think it illustrates the power of the big three. Essentially, you have, as you mentioned, a very small owner, a very small hedge fund with pretty minuscule ownership, traditionally no say, but we almost have, they're lobbying these large index funds, particularly the big three. And the big three are almost sitting there sort of, with a thumb and say, vote up or vote down, and say they have the ultimate decisional power, the sort of the arbiters of corporate law controversies. And I think that is a dangerous situation, and I don't think it's good corporate governance.
All right. Chairman, thank you.
Thank you very much, Senator Daines. To the two professors, thank you. Professor Coates, thank you. Professor Griffin, thank you for testifying today. For senators who wish to submit questions for the hearing record, those questions are due 1 week from today on Tuesday, June 21st. To the witnesses, please submit your responses to questions for the record within 45 days from the day you receive them. Thanks again for your testimony. The hearing is adjourned.